All right, we're going to tackle another frequently asked question or a question from our community. This one comes from the Texas Boys. So shout out to them and their channel. I took a look. They got some really cool content over there. This question is, if your loans are already on a monthly repayment schedule, so this is assuming policy loans, how do you decide whether to use additional income? So good news is you're making additional income. That's great. To pay down loan balances or to buy PUA or paid up additions. What factors do you consider and how would you make that calculation? So really good question. I love this question. There's a couple elements here. So the answer to this is, the reality is it depends. Everyone's situation is going to be a little bit different. First, let's address the elements of behavior. This really is going to come down to behavioral actions, because if you're brand new and you're just getting started, you've taken your first loan or maybe your second loan, you're 1 year in, maybe 2 years in, you probably don't have enough practice at doing this yet to start to be able to make those decisions. So personally, I always recommend we focus on repaying the loan so that we get really good at what we're doing and we practice returning the piece. Once you've done this enough times, you can start to say, you know what? I feel like I got this down really, really good. Now I might start to mix it up a little bit. Maybe I'll keep my original loan repayment going to the policy loan. And if I have room in my policies, I'm going to send some more to the paid up additions. Again, it also depends on some of the policy design and the current structure you have, because everyone's policy is going to be a little bit different depending on the life company, the country. So if you're in Canada versus in States, again, different companies have slightly different variables available to them. And there's a lot of dynamics there. So there's no one size fits all answer. Ultimately, here's the key element. If you look at Nelson in his book, and I'm going to take us to page 44. So I don't have my version of the book here, but I've got a newer version. In fact, my original version of the book doesn't even have page 44 in it. I had to tear it apart and get it bound and laminated and stick a page. I actually had to tear my book apart and a new book apart to put page 44 addendum in. There was a page 44, but there was no addendum page. So there's a whole addendum here, and this has to do with the twin sister example in Nelson's book. One of the things Nelson says on the far side of page 44, there are only two hard and fast rules in carrying out this concept. Number one, don't be afraid to capitalize the system. The more capital you put in, the more you get back, tax-free at passive income time. Number two, don't make policy loans without making provisions. I would underline and highlight the word provisions for paying them back. In essence, stealing from your system. Just as in the grocery business, don't steal the peace. How simple can it get? Furthermore, this procedure provides a place to put windfall money. The procedure meaning loans. You have access to loans in your loan portfolio, as Nelson would call it, or David Stearns would call it. That means if you come into windfall value, you sell property, you have a really good year in your business, you have more profits, you have a tax refund, you get a bunch of money at Christmas, whatever those types of things are, you sell an investment, etc. Then you have a place to put that money so that there's a spot for it rather than it disappearing in some other area of your life, which is really common. History shows us that when people have a windfall event of capital, it finds a way to get eroded or depleted, or it disappears very quickly, often to a point where no one even knows where it's gone. That's the element that we're trying to eliminate, and having a place for storing windfalls is part of that. So policy loans, or a policy loan portfolio, as David Stearns would say, gives you a location to place that capital. In fact, they were able to do that when Nelson himself passed away, and they received tax-free death benefits from Nelson. And each of his kids received basically $500,000 tax-free. And then if they had outstanding policy loans, they had a place to go put that capital, because they weren't paying $500,000 a year in premium. They didn't have a place to put it into premium, but they could store it in the system one way or another. So going back to the question from the Texas Boys here, if your loans are already on a monthly schedule, so that's good. You're being consistent. You're being an honest banker. You set up a payment schedule. So check, check, check. How do you decide whether to use additional income to pay down the loan balances or buy PUA? In Nelson's book, he further goes on to explain in the equipment financing example that the purpose or the intention of the quote-unquote extra interest should be to pay additional premium in a policy. Paid up additions is a premium. Premium purchase is a death benefit. Death benefit creates cash value. That's how it works. We have a great video that we can link to about how the secret of paid up additions and how paid up additions work towards creating both an inflation hedge and a constant accumulation effect on your policy values. People think sometimes, or there's a lot of misinformation out there, that there's a quote-unquote rate of return of the policy. That's irrelevant. You buy death benefit. Death benefit is a contractual element. cash value must grow to equal that death benefit at the contract maturity date. So if you have an age 121 contract or an age 100 contract or whatever that is, the cash value has to grow and chase after that future element. So if I take $1 today and I buy, let's just say $4 or $5 of death benefit, now I've locked in today's dollar and I've created a future guarantee that's 4 to 5 times greater than today's dollar, because the cash has to grow to follow that new element. That's what really causes a policy to grow. So where possible, you always want to be paying that extra paid up additions. If you have room for it, you want to fund it. If you have extra income and something has changed or is new from when you created that first policy and you created that first loan arrangement, one of the other elements that Nelson would say is you've got to follow through on your loan schedule, stick through your loan schedule. So if you were to pay the loan off early, that's fine. However, you made a commitment of making payments for a period of time. So even if you pay the loan off early to the life company, that payment stream that you committed to technically hasn't changed. You are going to make that payment to someone, in this case, the life company and the policy, continue to make that payment, in which case, if there's no more loan to service, that payment now entirely should be going to paid up additions or to a new policy in your system. So the kind of end result is that you're accomplishing the same thing, whether you start moving new money towards PUA now, or you eliminate the loan quicker, but you had set an intention to repay that loan. So I'll give you an example. Let's just say the loan was over 5 years for a car, and you're making a $1,000 car payment. Great, you're going to pay interest to the life company. The policy loan balance is coming down as you're making that $1,000 payment. Well, if you have new money coming in and you start paying down that loan faster, or you put a lump sum down on it, well, now that loan is fully repaid to the life company in 3 years, let's just say. Well, you committed to 5 years. That means there's 2 more years of payments. That's $1,000 a month. That $1,000 a month you committed to should still go to your system because you made a commitment to do that. How are you getting it in? It's going into PUA in a current policy you have available in your plan, or do you need to reach out to your advisor who you're working with, who's an authorized infinite banking a practitioner, and do you need to go ahead and get a new policy? So this is how expansion happens. It's also why Nelson talks about a system of policies. He does that in a couple locations in the book. Top of page 25, I should say. Would you have much of a grocery business if you were the only customer? You must build it to the point where you can accommodate the needs of others in order to prosper. The same principle applies in banking. Furthermore, I'm not describing one life insurance policy. This is to be a system of policies. Have you not noticed that when a grocery store becomes successful in one location, it tends to establish another store in another location? Have you not noticed that banks have branch officers? There must be a reason for this behavior. Then why not expand your own potential by buying all the insurance on yourself that the companies will issue, and then on all the persons in which you have an insurable interest? At present, doesn't all of your income go through the books of someone else's banking institution? Don't the banks lend out the deposits to customers? All they do is capitalize the bank to make it a safe place to deposit money and then lend that money out. So Nelson's telling us here that if you think about the simplicity of what other institutions and businesses are doing, including banks, we're just trying to mirror and model that same element. He also expands on this a little bit. I won't read too much, but he also talks about this on page 48 and 49, the title of which is Expanding the System to Encompass All Income. So Nelson goes over some really good elements here that further identifies the need to be a system of policies. So I hope that answers the question. What should you do and how do you make the calculation? The calculation isn't a calculation that's necessary. It is, do you have the ability to expand? Do you want to expand? Is it going to constrain you financially, or is it reasonable to do financially? And are you going to finish your loan schedule? You got a loan schedule, finish it. If you're paying that loan off early, that means you have that cash flow available, which means it should still go to the system. If it can't go towards a loan, it should go towards premium. If you don't have room in premium, you go get some more room. That means a new policy on you, a term conversion, a policy on a loved one, a spouse, a child, a grandchild, a business partner, who's an insurable person in your life that you can go get another policy on, so you can accommodate and build towards Nelson's principles. Hope that helps. Really good question. Thanks for the Texas boys for answering. We found this really valuable, and it looks like you got a cool channel. I'll reach out and check out some of your content as well. Thanks for being a subscriber to our stuff. For those of you watching, of course, we do have a number of great books. This one's called Cash Follows the Leader. You can get a free download of this book if you want by going to cashfollows.com. That's cashfollows.com. And if you want to get an amazing copy of this great book, Don't Spread the Wealth, you can go to don'tspreadwealth.com. That's don'tspreadwealth.com and get a copy right there. Thanks so much for listening and paying attention. Absolutely love the infinite banking concept. Love to hear how the infinite banking concept is working for you. Feel free to comment down below and put some more of those great questions in so we can tackle them as they show up. Thanks a lot. Bye.